Hey everyone, welcome back to Corporate Decoder, the place where we dive deep into the exciting world of industrial real estate. Okay, I know what you're thinking, but trust me, this report from Modiv Industrial has a few surprises, including a shift in strategy, a potential name change, and of course, some good old-fashioned risk factors. We're going to crack open their 10K report, the annual deep dive that companies have to file with the SEC. So what's the story here? Modiv Industrial, they're a REIT or Real Estate Investment Trust, which means they own and manage properties and have to distribute a big chunk of their profits to shareholders. They focus on single-tenant net lease properties, specifically industrial manufacturing facilities. Basically, they own the buildings that make the stuff that makes our world go round, the big news. They're laser-focused on snagging more of these industrial sites while shedding some of their non-core holdings. First, let's talk numbers. The company reported the value of Class C common stock held by non-affiliates at around $134 million, which is a measure of the company's public value. But remember, those numbers are just snapshots in time. Now you can't talk about investments without talking about risk, and Modiv's got a whole section dedicated to it. And boy, are there a lot of risks. First off, there's no guarantee that Modiv's stock will always be easy to trade. A lack of an active market can make things volatile. A lack of institutional investment can make it hard to attract big investors. Then there's the pecking order of their stock. Class C common stock is subordinate to other stocks and debt, which means Class C shareholders get paid last. The issuance of additional stocks and bonds could dilute the holdings of common stockholders. In today's world, cybersecurity can't be ignored. Think of a cyber attack as someone breaking into the company's digital filing cabinets. If hackers steal sensitive data or disrupt operations, it could be a costly mess and damage Modiv's reputation. Finding good deals in real estate is a dog-eat-dog world. Modiv is up against bigger players with deeper pockets like pension funds and private equity firms who are also hunting for good real estate investments. This competition can drive up prices and make it harder for Modiv to grow. Then there's Modiv's strategy of selling off properties, which is also a risk. It takes time to find the right buyer, and market conditions can change. Here comes some accounting jargon, but it's important. Real estate values can decline, leading to impairment charges, which basically means writing down the value of an asset. This can sting profits. Think of it like relying on a single big client. If Modiv's biggest tenant has financial troubles or decides not to renew a lease, it hits Modiv hard. The company is focused on industrial properties, but it could change its mind. If they change the investment or acquisition strategies, it could become riskier to the company and dilute the portfolio. Change of control can be really difficult. The company can't be easily acquired due to the laws in its charter and bylaws. Bad weather isn't just a bummer, it can damage properties, disrupt operations, and even make it hard to get insurance. Single tenant also leads to more issues. A single tenant leaving can make the business fall apart. Debt can be a dangerous game. If Modiv can't manage its debt payments, it could face some serious consequences. Lenders often put restrictions on what a company can do, like limiting dividends or dictating financial ratios. If Modiv violates these covenants, it could be forced to repay its debts early. Tax policy is always in flux. New laws could make it less attractive to be a REIT, impacting Modiv's bottom line. Now let's move on to the juicy stuff, Modiv's actual properties. As of the end of 2024, they had non-fraction context ref equals C7 decimals equals inf, format equals ixt, num.decimal ID equals F837, name equals a scop, number of operating properties, scale equals 0, unit ref equals property 43/non-fraction properties, most of which are industrial spaces, including one held for sale. Most of the properties are in industrial assets, while there are a few non-core ones and one property held for sale. Here's the breakdown. 8 properties are located in California, and there are tenants doing business in 12 separate industries. These tenants create $39.6 million in annual base rent, which calculates to the monthly dividends. Now for table of contents. The last share volume was over 9.9 million for the company, indicating interest in this stock to purchase. Management believes that the company has enough funds and the debt market remains sensitive to the macro environment. This may be a struggle. But how do they make sure they are able to get paid by their tenants? To make sure, the company assess creditworthiness and payment histories. In other words, they don't just rent to anyone. Of particular note, the fine print on their debt. This is often buried in filings like this, but this is super important. These limitations include making distributions, operational flexibility, and acquisition and disposition activities. The company often purchases properties with the intention of long-term lease. Some provisions of Maryland law may limit the ability of a third party to acquire control of us. One area that gets attention is the company's cybersecurity. The company is continually evaluating their cybersecurity through many methods. The company utilizes risk assessment and management and incident management to combat attacks. The audit committee receives periodic reports from the chief accounting officer about cybersecurity. Also, management is also responsible for cybersecurity risks. There are no current risks that materially affected the registrant, but some potential risks may affect the company, including exploitation of vulnerabilities, ransomware, unauthorized transactions, or other similar threats. Here's what every investor wants to know. For last year, a big chunk of the distributions, like 84%, was classified as return of capital. A return of capital can be tax advantaged. Here's some other great news for investors. Starting next year, the board of directors authorized a small 1.7% increase in the annual distribution rate. In mid-2024, the company purchased units for about $11 million. To prevent conflicts of interest, the company created transaction policies regarding this topic to prevent its board of directors from abusing their position. The contact details of the company's headquarters, which are available online. Now for my take on Modiv Industrial. They're making a clear push into the industrial manufacturing sector, which seems like a smart move given current trends in onshoring and supply chain resilience. Their debt burden does warrant careful monitoring, especially with interest rates still elevated. And you can't ignore those tenant concentration risks. Losing a big tenant would definitely hurt. Overall, Modiv seems to be executing a well-defined strategy, but it's not without its challenges. The shift towards industrial properties is promising, but they need to manage their debt and diversify their tenant base to ensure long-term stability. Investors should definitely keep a close eye on their progress in these areas. Thanks for tuning into Corporate Decoder. If you found this breakdown helpful, don't forget to hit that like button, leave a comment, and subscribe for more deep dives into the world of corporate filings. See you next time.